Hey everyone, so you're working for yourself. Awesome. It comes with a ton of freedom, right? But it also comes with a lot of questions, especially about taxes. In the next few minutes, we're going to break down self-employment income here in Canada and make it all make sense. Let's dive in.
So, does this sound like you? Maybe you're driving for a rideshare app on weekends, or selling your incredible creations on Etsy. Or maybe you're a full-time freelance writer or designer. If you're not in your head right now, yeah, this explainer is 100% for you.
All right, first things first. What does it actually mean to be self-employed in the eyes of the Canada Revenue Agency? Well, the definition is probably a lot bigger than you think.
Okay, the official definition talks about business income and contracts for services, which sounds super formal, but here's a much simpler way to think about it. If you get paid for your work and there's no employer taking off tax deductions from that paycheck, you're almost definitely self-employed.
And this covers a massive range of jobs. We're talking about the whole gig economy. Driving for Uber, delivering for DoorDash, selling on Etsy, or even being a social media influencer. But it also includes the classic independent trades, like carpenters, electricians, and plumbers. It's a really wide net.
Now here's a curveball that a lot of people miss. What happens when you trade your services for someone else's and no actual money changes hands? This is called a barter transaction. And you guessed it, the CRA counts it as income.
Let's look at this example. Zane does some drywall work for Avril. In return, Avril does some mechanical work for Zane. Now here's the crucial part. They both have to report the fair market value of the service they received. So, Zane reports the $1,500 value of the mechanical work he got, and Avril reports the $900 value of the drywall work she got. Okay, so you have to report your income. We get it. It's the law. But let's flip the script. Beyond just following the rules, there are actually some really significant financial perks to doing this. Let's talk about why this is actually a good thing for you. Look, when you report your income, you're building an official financial story for yourself. This paper trail can help you get approved for a bigger mortgage or a loan. It boosts how much you can put into your RRSP for retirement. And, this is a big one, it means you're paying into your future pension.
Which brings us to the Canada and Quebec pension plans. The best way to think about these is as a forced savings plan for your retirement. And as a self-employed person, you're in the driver's seat. You make your own contributions, and that builds a financial safety net for your future self.
Now, if you only take one thing away from this whole explainer, let it be this. If you are earning self-employment income, you are running a business. Full stop. It's time for that mindset shift. Congratulations, you're an entrepreneur. And every business has a structure. Now, if you're working by yourself, you automatically become what's called a sole proprietorship. It's the simplest way to get started. You and your business are legally the same thing. Down the road, you can look at partnerships or incorporating, but for now, just know that you're a sole proprietor.
And what does a business do? It tries to make a profit. This little formula right here is your new best friend. All the money you bring in, minus all your eligible business expenses, equals your profit. That final profit number? That's what you actually pay tax on.
Okay, thinking like a business owner might feel a little overwhelming, but don't worry. It really just boils down to 3 core responsibilities. Let's break them down into simple, manageable steps. Here they are. Number 1, keep good records. Track every single dollar that comes in and every dollar that goes out. 2, report it all on your tax return. And 3, contribute to your pension plan. That's the whole cycle. Track, report, contribute. When it's time to report, this is the form you need to know, the T2225. Think of it as the scorecard for your business. It's where you list all your income, subtract all your expenses, and calculate that net profit that you'll be taxed on. Now, about those pension contributions, there's a really key difference compared to being a regular employee. You're now on the hook for paying both sides of your CPP or QPP contributions, the part the employee pays and the part the employer would have paid. So yes, it's a higher rate, but it also means a bigger payout for you in retirement.
All right, you've got the basics down. You're tracking, you're thinking like a business. Now it's time for the final boss level. Understanding sales tax, also known as GST and HST. Now, this is where it can get a little tricky, but stick with me, we're going to make it simple.
This is the big question, right? Do I need to register for a GST/HST account and start charging and sending in sales tax? Well, the classic answer is, it depends.
And most of the time, what it depends on is this number, $30,000. I want you to burn this number into your brain. It is the absolute key to figuring out your GST and HST obligations. So here's how it breaks down.
If your business earns more than $30,000 in any 4 straight quarters, so over a 1-year period, you must register. If you earn less, you can choose to register voluntarily. But, and this is a huge but, look at that second line. If you are a rideshare or taxi driver, you must register from your very first dollar of income. No exceptions.
I'm just going to say this one more time because it is so incredibly important and catches so many people out. That $30,000 rule does not apply to rideshare and taxi drivers. You have to register, collect, and send in GST or HST on every single fare, right from day one.
But hey, registering for GST/HST isn't all bad news. There's a major perk. You get to claim back the sales tax that you pay on your business expenses. These are called input tax credits, or ITCs. So the GST or HST you paid on things like fuel for your car, legal fees, or even your office rent can be subtracted from the tax you collected, which means you owe less to the government.
Okay, let's bring it all home. What are the big takeaways? Number 1, you are a business owner, so start thinking like one. Number 2, your main duties are simple: track, report, and contribute. And number 3, when it comes to sales tax, it all comes down to that $30,000 rule, unless you're a rideshare driver.
So, I'll leave you with a little bit of homework. Now that you're wearing your business owner hat, what's one legitimate business expense you can claim that you just hadn't thought of before today? Because that new way of thinking, it starts right now. Thanks for tuning in.